With the US government shutdown having now ended, we are finally going to be getting some official data releases from the states, and the most notable of those, at least this week anyway, will be the September US labour market report. The data is of course pretty stale at this point, but nonetheless it is going to be closely watched by policymakers and participants alike, as it is the first official US labour market data that we've had for about 2.5 months now. Headline non-farm payrolls are seen having risen by 50,000 in September, roughly double the pace that we saw in August, though the range of estimates for that payrolls print is as wide as ever, from a jobs decline of 20,000 on the downside to jobs growth of 105,000 on the upside. As for other areas of the report, average hourly earnings set to remain unchanged at 0.3% on the month and 3.7% on the year, reinforcing the FOMC's view that the labour market is not a source of significant upside pressure at this moment in time. Meanwhile, looking at the household survey, headline unemployment is set to remain at 4.3%, equal to the cycle high that we saw in August, while labour force participation, that's seen holding steady at 62.3%, just 0.1% above the cycle lows that we saw during the summer. In terms of the policy implications of the report, although the data is somewhat out of date, it is nonetheless going to be a significant driver in shaping expectations for the upcoming FOMC meeting on the 10th of December, particularly with money markets now pricing a roughly even chance between a 25 basis point cut and rates remaining on hold at that December confab, with the hawkish repricing in recent weeks coming largely on the back of a number of hawkish remarks from regional Fed presidents who have indicated potentially a reluctance to lower the Fed funds rate further, particularly given simmering signs of services inflation continuing to bubble away within the US economy. Nevertheless, we are likely, albeit not certain, to get both the October and November jobs reports in the run-up to that December FOMC meeting, so there will be plenty of data for policymakers to chew over before making that decision at the end of the year. My base case at this moment in time remains that the Fed do indeed deliver another 25 basis point cut at that final meeting of the year, likely seeking to continue to prop up the labour market with jobs growth stalling and inflation gradually, but not very quickly, moving back towards that 2% target, although the committee are likely to remain divided over the appropriate policy action. As for markets over the September non-farm payrolls number, the key question is whether it will be a case of good news is good news for equities, which bounce on the back of a strong report, or good news is bad news if it leads to the market pricing a much tighter policy outlook, though fundamentally the path of least resistance for Wall Street continues to lead to the upside.